So in my mind, I've kind of got three sections that I would love to go through. The first is what is the asset allocation decision? That part is really short and easy. The second is why is it important? And the third is how do we at PWL help our clients make their own asset allocation decision? And I will just preface that you heard me a couple episodes ago talking about how we help clients make insurance decisions in the context of their own financial plan. That isn't going to look any different than asset allocation. It will always be from the perspective of a financial planning engagement. So it won't be anything different than that. But to kick things off, what the asset allocation decision is in a nutshell is the proportion of stocks to bonds that investors choose to hold in their long-term investment portfolio. So that could look something like 60% stocks, 40% bonds. That could be 100% stocks. That could be 100% bonds. So there's a lot of variety there. And I will also say that the asset allocation decision is probably the largest decision, in my view, that any client makes when working with us. When I think about all of these kind of ideas that we bring to the table in terms of helping clients build more wealth over their lifetimes, getting your asset allocation strategy nailed down from the get-go is up there for me. So we know what asset allocation is or what that decision could look like. Why is it important? And in very simple form, it's inflation. We know that our money is worth less over time. We know that if we walk into a grocery store with 10 bucks today, we might walk out with five apples, but if we do it again in 10 years, we're probably walking out with less. The Bank of Canada has a really cool calculator on their website where you can go and look at various points in time and plug in, if I bought something for a dollar in 1970, how much would it cost me today in 2025? So I went through that exercise and I was pretty shocked. Something that costed a dollar 55 years ago now costs over $8 today. So at that point, it's kind of obvious that as investors, there's some sort of action that we should be taking to make sure that our money is keeping up with inflation over time, if not outpacing it. Because eventually we all want to get to a point where we're financially independent, we can turn off our incomes, and then eventually rely on our portfolio to maintain our standard of living. So we know to get to that point, there needs to be some sort of action or activity on our end. Now, we've always been a very research and evidence-based team, and there's a ton of research and evidence that suggests that a great way to combat inflation is to invest in stocks and bonds for your long-term money. That's not for your immediate needs. Our colleague Ray put together a really interesting blog a few months ago where he took a look at what $1 invested in different asset allocation strategies was worth by the end of 2024. And I've got that right in front of me. I thought it was kind of interesting to go through the results. If you were invested in 100% bonds, your dollar invested in 1970 turned into almost 49 bucks. If I think of a more of a medium risk portfolio where it's 60% stocks, 40% bonds, your dollar turned into $98. And if you were in 100% stocks, your dollar in 1970 turned into over 130 bucks. So you might look at all of that upside and say, well, why wouldn't I just invest in 100% stocks? And I think the answer from my perspective is because investing is risky and stocks and bonds have different risks. Stocks are risky because they fluctuate pretty dramatically in the short term, and bonds are risky because they have lower expected returns relative to stocks, and they're very sensitive to changes in the interest rate environment. So we kind of just mapped out what some of the upside for investors has been over the last 55 years in various strategies. Let's think about the downside. And the most extreme one that comes to my mind and call it the last 20 years was 2008. And I thought it was interesting to look at a couple of different strategies to understand what is the worst thing that an investor could have experienced. And if you were in 100% stocks, your portfolio in 2008 declined 48% in value. It's pretty extreme. And not only did it decline 48%, but you also had to sit on your hands and do nothing for 4 years just to break even again. Like that is That's a different way to think about your asset allocation decision. If I think about a portfolio with less stocks and more bonds, thinking about 40-60 split in this example, your portfolio in 2008 declined 19%. And not only did it go down by 19%, but it only took 9 months to recover. So it becomes really interesting to reframe how we think about stocks and bonds as stock, including more stocks in your portfolio is a really interesting way to increase the ceiling for how much wealth you can accumulate over your lifetime. But including more bonds in the portfolio is also a really great way to avoid a more serious market correction as equities fluctuate.
Can I can
Now,
I can I add a comment
shoot,
there?
shoot.
I think like in Ray's example, the post that was a post 1970 sample. Bonds did pretty well, but if you look at like broader samples, like that's the Scott Cederberg kind of research, there's a pretty good chance if you look at a global sample that bonds lose value to inflation for long-term investors. So it might protect you from short-term downside risk, but bonds have their own totally unique risks for particularly for long-term investors. And stocks have relatively been pretty protective of that type of erosion of purchasing power in the long run.
Yeah, it's a fair point. And Ray's article was also using just Canadian bonds. So that's something that's a little bit more cherry picked and not as robust as it should be when making this decision. It was more for illustrative purposes, but it's a totally fair point. I think the other thing that we cannot do as planners and advisors, Ben and Dan and other Ben, if you guys feel differently, is actually tell clients how much risk they should be taking. I think that risk is very personal. Everybody's got different experiences growing up with money. They've got different levels of comfort and awareness investing in stock and bond markets. So the goal will always be to help clients make an informed and educated decision, but not by telling them what they should do.
Yeah, I agree with that, Louis. With the other thing that we also keep in mind as advisors is, although we're not telling them what to do, as you said, we're educating them and letting them come to a decision. But as advisors, we're also in this every day. So we're kind of thinking and evaluating all the different factors that go into that decision, their experience, their time horizon, their objectives, etc., and then helping them to understand an asset allocation that is actually suitable for them. Because someone might just say, "Oh, this looks good to me," and never actually experienced it. But it, it's a lot different to actually go through it yourself. Like you gave the 2008 example, you don't know how you're going to react to that until you've actually been through it with your own money, and it's hard to predict that in advance.
Can that go in the other direction too, Ben? Like, can there be cases where a client wants to have a portfolio that's really, really conservative because they maybe aren't understanding the long-term risks that they're exposed to?
Oh, absolutely. I've had conversations like that with clients where when we look at their risk, we have a risk tolerance questionnaire that Louis is going to get into, but they got a really low score on that. But they were 30-year-old investors with high incomes and trusted to work with us to help them make good decisions. If we just took that score on its own, they would have been a low risk investor that would have put their results at risk. But we kind of looked at the all the other factors that come into that decision and recommended a more appropriate risk with higher stock allocation in that case.
I will jump into the risk questionnaires that we send the clients, and these aren't proprietary to PWL. There's some really great ones for DIY investors. Vanguard has an awesome one, but we're trying to help clients nail down two key components of risk. The first is their tolerance, their willingness to take on risk. And we send clients a short questionnaire that goes through, simulated market declines, understanding if they had excess cash, would they put it against their mortgage? Would they buy real estate? Would they buy stocks or bonds? I find that that's a nice exercise to get a little bit of a pulse check on how clients feel about risk, but it's by no means where we stop in terms of actually deciding on asset allocation. The other thing that's really interesting with these risk tolerance questionnaires is that when you're working with spouses, it is so rare for them to have the exact same outcomes. And this is where you can really dive in and understand what the differences are and why they exist. Is one person savvier than the other? Is one person doing more of the household investing and planning to the point where the other person doesn't feel comfortable? I'm gonna jump into this in the next section a little bit more, but we had a client who their spouse was totally down to be in 100% equity. He gets the research. He's a rational reminder nerd. He was ready. His spouse was more like 80/20, 70/30. She was less comfortable. We chatted through her survey responses, and what we found was that what kept her from being in 100% equity was a little bit of insecurity around what would happen in the short term if one of them were to get sick or lose their jobs. And we did some really thoughtful planning around emergency funds and insurance, and then she ended up in 100% equity very comfortably. So this is just a perfect example of where you cannot take these survey results at face value and you've got to dive deeper.
I'd be really interested to hear, maybe before you jump into the risk tolerance topic, Louis, how Dan and Ben Wilson work through that when spouses have extremely different risk tolerance answers.
I think it comes up often, and we see cases often where there tends to be one spouse that is more financially dominant, that kind of the other spouse just trusts them to make the decision. And is when we look at that, the two different scores, we can't just rely on the more financially savvy spouse's risk tolerance and score. We need to take both into consideration, even if most of the money is sourced by the higher income spouse who happens to be the financially savvy one. We need to view them as separate individuals as part of the same household, and we can't just say your husband's great with 100% equity, we're going to do that. We got to evaluate and understand why one might be higher than the other, and come to a decision that makes sense for everybody. Sometimes that means the lower risk tolerance spouse moves up. Sometimes it means the higher risk tolerance spouse moves down. Sometimes it means we have two separate asset mixes for their respective pots of money.
Yeah, I would say we do it very similarly as well. I mean, sometimes you will see this with spouses who are of different ages, and therefore, like dramatically different ages, and therefore perhaps one is already retired and the other one is still working. In that kind of case, it could make sense to have two separate investment policy statements with two different asset allocations. Now, that has more to do, I think, with time horizon than it does with temperament. But I agree, Ben, with what you said about you can't just simply say, well, spouse A looks after most of the investment decisions, so we're going to default to his or her risk tolerance, because it's disrespectful of the other one, I think. And in most cases, I think you have to come down closer to the more conservative spouse, because going the other direction just creates too many potential problems. So oftentimes we'll have a discussion, we'll try to meet in the middle somewhere, right? So, I mean, you don't often get one spouse who wants 100% equities and the other one who wants 50. Like, that would be a really dramatic difference. And sometimes I find, honestly, the difference between 60 and 70% equities on a day-to-day basis is trivial, right? Like, you're not going to notice that in short to medium term movements in the market, I don't think. And so you can often just kind of meet in the middle, do 65, right? But I think it's just the important thing is to listen to both spouses and understand what their concerns are, and not be dismissive of one who you feel is either too aggressive or too conservative based on your own opinions.
Yeah, in a more extreme case where one spouse like truly doesn't care and is disengaged, the only option we really have is, if you are completely delegating this to your spouse, we need you to sign a power of attorney document to delegate that control and authority to them, which we have done in some cases. But usually once you get to that part of the conversation, like, okay, well, I'm not sure I want to do that fully. And then you get the other spouse more engaged in the decision.
That's really interesting. because it's implied that they're delegating before they sign. But once you make it explicit, they're like, oh, maybe I actually don't want to do this.
Yeah, exactly.
Yeah.
So that was the risk tolerance component of those surveys that we send out.